Welcome back again to our channel, your go-to hub for mastering the world of finance and fintech, and empower you to make smarter money moves in the digital age. In this episode, let's dive into how much should you be saving for retirement. When it comes to retirement, one of the most common questions is how much should you be saving? The answer can vary based on several factors, including your age, lifestyle, income, and retirement goals. However, there are general guidelines that can help you get a clearer picture of how much you should save to ensure a comfortable retirement. In this guide, we'll break down the key principles for calculating how much you need to save and offer strategies for building your retirement nest egg. 1. The 15% rule, a general guideline. A common rule of thumb for saving for retirement is to aim to save 15% of your gross income each year. This applies whether you're just starting your career or are closer to retirement. If you're unable to save 15% right away, don't worry. Start with what you can and gradually increase the amount over time. Example: if your annual income is $50,000, saving 15% would mean contributing $7,500 per year to your retirement accounts, $400 an ONIC, IRA, etc. Why 15%? The 15% savings rate is based on the assumption that your retirement will last for several decades and that your retirement accounts will grow through investment returns. Starting early allows compound interest to work in your favor, growing your savings significantly over time. 2. The 25x rule. Estimate how much you'll need in retirement. Another essential question when saving for retirement is how much will you actually need? A commonly used guideline is the 25x rule, which states that you need to save 25 times your annual expenses to cover retirement. How to calculate using the 25x rule. 1. Estimate your annual expenses in retirement. Start by estimating how much you'll need to spend each year in retirement. This includes housing, utilities, healthcare, food, travel, and other personal expenses. 2. Multiply by 25. Once you have an estimate of your annual expenses, multiply that number by 25. This gives you a rough idea of how much you need to have saved by the time you retire. Example: if you expect to spend $40,000 per year in retirement, you'll need $1 million saved up. $40,000 is 25. Adjusting for your retirement goals. The 25x rule is a general guideline, but your actual needs may vary based on factors like healthcare costs, inflation, or whether you plan to downsize or travel frequently during retirement. Keep in mind that if you plan on living in a more expensive area or want to maintain a certain lifestyle, you may need to save more than this guideline suggests. 3. How much to save at different ages. Your savings target changes based on your age. The earlier you start, the more time you have to benefit from compound interest. Here's a general breakdown of how much you should have saved by key ages to stay on track for retirement. In your 20s, start early and build momentum. Goal: save at least 10 to 15% of your income for retirement. How much should you have saved by age 30? Aim to have about 1x your annual salary saved by the time you're 30. Why start in your 20s? The earlier you start saving, the less you have to contribute each month to reach your retirement goal. Compound interest works best over long periods, so starting early gives your money more time to grow. In your 30s, focus on growing your savings. Goal: continue contributing 15% of your income to retirement accounts, if possible. How much should you have saved by age 40? Aim to have 3x your annual salary saved by the time you're 40. Tip: in your 30s, Your earning potential may increase, so it's a good time to increase your savings rate or contribute more to retirement accounts like your 400 and ONC or IRA. In your 40s, accelerate your contributions. Goal: contribute the maximum allowable amount to your retirement accounts. As you approach your peak earning years, try to save as much as possible. How much should you have saved by age 50? Aim to have 5x your annual salary saved by the time you're 50. Tip: you may be able to contribute more due to catch-up contributions if you're 50 or older, allowing you to put additional funds into your 400 and ONC or IRA. In your 50s, plan for retirement. Goal: prioritize saving for retirement. Focus on maximizing your retirement account contributions. How much should you have saved by age 60? Aim to have 8x your annual salary saved by the time you're 60. Tip: at this stage, it's important to review your retirement goals and adjust them if needed. Start thinking about how you'll draw income in retirement and whether your savings will last. In your 60s, prepare for retirement. Goal: maximize contributions and start transitioning your portfolio to be more conservative. How much should you have saved by age 67? Ideally, you want to have 10x your annual salary saved by the time you retire. Tip: once you hit age 70, begin planning for required minimum distributions, RMDs, from your traditional 400 and ONC or IRA, which start at age 73. 4. Use retirement calculators. If you're unsure how much you need to save or whether you're on track for retirement, there are many retirement calculators available online. These calculators ask for basic information such as your current savings, expected retirement age, and estimated monthly expenses to give you an estimate of how much you should save each month. 5. Strategies for saving more for retirement. If you're not on track to meet your retirement goals, don't worry, you can still catch up. Here are some tips to boost your savings rate. Increase your contributions. If possible, increase the percentage of your income you contribute to retirement accounts. Even small increases can make a big difference over time. Take advantage of employer matching. If your employer offers a 400 and ONC match, contribute enough to take full advantage of it. This is essentially free money. Cut unnecessary expenses. Review your budget to identify areas where you can cut back on spending and redirect those funds into your retirement savings. Max out tax-advantaged accounts. Contribute the maximum allowed to your 400 and ONC, IRA, or other retirement accounts. Consider using catch-up contributions if you're over 50. 6. Adjusting for inflation and healthcare costs. Inflation and healthcare costs can have a significant impact on your retirement savings. Over time, the cost of goods and services tends to increase, so it's essential to factor in inflation when calculating how much you'll need. Healthcare costs. As you age, healthcare costs tend to rise. Make sure to account for healthcare expenses in your retirement planning. If you're eligible, consider contributing to a health savings account, HSA, to cover medical expenses in retirement. In conclusion, the earlier you start, the better. While the exact amount you need to save for retirement depends on your individual circumstances, following general guidelines like saving 15% of your income and aiming for 25 times your annual expenses can help keep you on track. Remember to regularly review your retirement plan to ensure you're making adequate progress. Start early to take advantage of compound interest. Save consistently and increase your contributions as you earn more. Adjust your strategy as you approach retirement age to ensure your savings last. By following these steps and being proactive about your retirement savings, you can achieve the financial security you need to enjoy your retirement without worry. If you found this video helpful, don't forget to like, subscribe, and click the bell icon for more finance tips. And if you have any questions about how much should you be saving for retirement, drop them in the comments below. Thanks for watching, and I'll see you in the next video.